Dang, all right. Competitive round one is where we're at. We had some interesting results. I always kind of look forward to Monday morning. It gives me something to look forward to process these results and see how you guys did. I hope that you're starting to get past all of the clunkiness from the start of this and figuring out the game and all that other good stuff. And I understand that that has its difficulties. I have yet to figure out a way to make it easier. I'm sorry. I try to think of new ways to make it easier, but I've yet to do that. And so, that said, yeah, we'll come back and take a look at that competitive round one and see how that turned out. Let's go back and look at the practice round 5 question and answers. I see we had quite a few submissions into the Dropbox, which was good. And I've looked through a couple of them. I looked through about 3 or 4. I just kind of want to get a sense of where folks were at. I didn't get to look at all of them. For that, I kind of apologize. But I kind of want to see how the answers were doing. It might differ, make me I don't know, emphasize something more or not. What I did find out was that I goofed up. I had some answers for mine that when I read your guys' answers, I said, oops, I misadded or missubtracted. Some of them were simple little things. So we all do that, including myself. Anyhow, for question number 1, it was Chester made more money, yet Erie had a higher ROE. Why? Same question could be asked using Andrews and Baldwin. And the answer would be the same either way. And the point that I'm really trying to get across here, the point that I am trying to get across is that it's the amount you make relative to the equity that's important. Okay? A small company, the biggest company in the world is Apple. And it makes more money than any other company in the world, to my knowledge. I think that's correct. Okay, I'm almost positive that that's correct. Okay, that's doesn't mean that I wouldn't do better investing in a small company. Sure, it doesn't make necessarily as much money overall, but I don't care. If I owned any part of Apple, Apple's got I don't know how many billions of shares outstanding. My share of Apple would be minuscule, right? Okay, and so I don't care that they make billions and billions of dollars. I care what they make for me, what my return on my bit of their equity is, or my return on the number of shares that I have, the return for the number of shares that I have, right? Relative to what I paid for the share, of course. And so I'm trying to emphasize here that I can invest in a small company, perhaps, that's going to do way better for me than that investment in Apple. Now, in this game, yeah, it's a little bit different. You guys have a lot of control over that. And of course, we all start out dead even, right? Everybody starts out dead even. You have the same number of sales and those types of things in round 0. And then that changes throughout. And and of course, your sales go up and your profits and making more money and all those other things. But we can't forget the finance side. Okay, we can't forget the side that says, oh, well, ROE, that's return on equity. That's net income divided by equity. Well, there's a couple ways that I can make that number be bigger, and I want it to be bigger. I want my return on equity to be bigger. I can get my net income to go up, and I should do everything I can to do that. But I can also make my equity go down. Does somebody really want to have their equity go down? Yeah, absolutely. Okay, we can have too much equity, and that was the point that I was making here, right? When we talked about, okay, Erie made less money, but had more equity. If I'm an investor, Erie versus Chester, I'm way happier with Erie than I am with Chester. I mean, it's not a huge difference, but 2.5%. 2.5% over a long period of time would add up to a significant amount of money. Okay, and I think the same thing Andrews and Baldwin. Andrews made less money, $1 million less, but had higher ROE. Okay, and and they did that because their equity was less than had to be, right? There's only two components: it's net income over equity, and so their equity had to be less. And I kind of put in mine. I probably wouldn't necessarily look for this in yours, but Erie or Chester, look at that, had $30 million more in cash than Erie, right? 30 million more. Baldwin had 30 million more in cash. I'm rounding it off, with obviously 28 million more. So let's just say 30, take 30 million from Baldwin and Chester. And that cash is just sitting there, right? It's not doing a dang thing. It's earning 0.01 if it's like me in its savings account. Whoop-de-doo. Okay? And yet, so you could drop the 30, didn't affect Andrews much, right? So you could drop the 30 million from Baldwin and be about equal with Andrews, and its equity then would go down to about the same, right, as Andrews. And so its ROE then would have been better. And the same's kind of true here. In fact, it's just about identical. Take 30 million from that, and you're at 92 million, so it's just about the same, and the ROE would be better. Okay, it's not always in cash. Okay, sometimes there's other things, but that's as important to look at, and that's kind of the purpose of the game. It's not all about just seeing who can make the most money. The biggest profits isn't always the end goal. Okay, and maybe it was in management class if you had management class, but this gets to be a little more sophisticated, and as CFOs or financial managers, chief financial officers, we kind of want to look at some of the other things because they're as important. It's why you see a lot of major corporations now engaging in stock buybacks. Okay, they're engaging in stock buybacks. Well, they reduce the number of shares outstanding. The cash going away doesn't really affect their ability to make money. Okay, not in any significant form. Okay, but they can reduce the number of shares that are outstanding by buying them back, giving money back to shareholders. Should make shareholders kind of happy in that case. Reduces the shares outstanding, so it would increase both their earnings per share and their ROE. And I think last year U.S. companies, this is not our game. U.S. companies truly engaged in about $1 trillion in stock buyback, something like that. I think between Apple and Microsoft, it's tens of billions a year that they buy back in their stock. And you got to remember that Apple Corporation's worth it's down now. It's probably 500 or 600 billion, somewhere in that neighborhood. So if they're buying back 20 billion, it's still significant, but you're relatively small. And Microsoft's worth 350, 400 billion. Same thing. If they're buying back 10 billion, okay. Let's go to the second question then. In the low end, Digby sales did not meet its potential. How much did that affect Digby sales in units and in dollars? Now, that should please be accurate. And so we got to go down below. Okay. This one, when I asked you to be accurate, we can't just go to the low end and guess anymore. Okay. I think I kind of warned you that these might be coming, right? I can't just come here and say, well, looks like they they sold about 16 and they could have sold about 25, so it looks like about 9%. Yeah, that doesn't cut it anymore. Okay. You got to come down here. Okay, and this one we have to break down because Digby, which is here, that's these D ones, it's product days in the low end, and the low end is this column. Okay, and that's all I'm concerned about, I think, is the low end. So its product days, it had a potential of 5.9 and it had an actual of 7.0. So days actually sold more than expected, which I'll show you on mine. And on the other hand, its Dell product, which is its normal low-end product, had potential of 18.7, but it only sold 10.2. So it missed out on 8.5%. And again, I'll show you that. So Dell, I broke it down, Dell in days, 18.7 potential versus 10.2 actual. So the 8.5% lost sales based on the total segment demand, right? Okay, total segment demand, not the actual sales, because we didn't meet demand as a total. Okay, so and the total demand was 15,451,000. So they lost out, and I added the zeros basically on 1,313,335 units of sales for Dale. It's almost a tongue twister. Okay, at $17.50, that was their price. So it lost dollar sales of nearly $23 million for Dell. Okay, nearly $23 million. Days, on the other hand, if you remember, it had a lower potential than actual, so it sold more days than it should have. Okay, days it sold potential 5.97, so 1.1 difference. Hopefully I did that math right. Gained sales based on total segment demand of same demand, right? 15,451,000. So they gained sales of 170,000 units. At Days' price is 22, not the 17 and a half. So it gained a dollar sales there of about 3.8 million. So total, I guess I could have totaled that up, would have been 19.2, something like that, million, somewhere in that neighborhood. That Digby actually could have made, extra sales that it could have made. Okay, it might have cannibalized itself had it made more Dell, which had all the potential, right? It would have taken away sales maybe from Days. Okay, and that's why we kind of net those out. So what were the total industry missed units sales in all 5 segments? And just wanted you to look at that. Traditional, we missed out on 739,000, and that's just simply looking at when we come up here to the traditional. I asked this. I don't think you guys pay enough attention to these stats and the traditional customer buying criteria for each of the segments, right? So unit demand was 11.6 roughly, and unit sales was 10.8. So we missed out on, okay, and those are in millions. I added the zeros here basically. So we missed out on a total of nearly 3 million. Okay, so you guys were short 3 million in total sales. It's huge, huge. Why were EAT's labor costs lower than SID? And this is one of those cases where I screwed up. I didn't have completely the right answer, and so you guys set me straight when I was looking through some of the ones that I had looked at, which is a reminder that anytime you guys, if you have some complaints or issues or questions about my answers, holler at me. I don't always get them right. I goof up every now and then. I have several times, and I've read through student answers and said, oh, cripes, I goofed up there. Okay, so call me on it. That's fine. No, I don't like to be wrong, but I have to admit that I am often. So I put a couple things that it wasn't. You guys wouldn't have to put those on there. I just put the same automation, so it's probably not automation, right? Productivity numbers are about the same. Okay, that comes from the HR. Automation is their investment in HR. I just put those that it wasn't. Second shift and overtime, though, right? Okay, SID had more second shift and thus had more overtime, and so that was part of it. And also, Erie had invested more money in TQM, and if you look at the percentages on the bottom, would have saved about 3 or 4%. Relatively small, but a little bit, right? Would have saved a little bit because of the TQM, and then also the second shift and overtime. And yet, I would hasten to remind you that the teams that did the best had used a lot of second shift and overtime. Okay, even though that makes your labor costs go up, you're fully utilizing or trying to fully utilize your plant. Okay, otherwise you have idle plant that's costing you money that just doesn't really show up. Okay, maybe you got to take my word for that one. So okay, so there we go. Now let's take a look at the round 1C. We got to get in there. Reports. By the way, when we started the competitive rounds, you guys probably noticed, I think it does each time. If you wanted to, you'd have to go back and download these as PDFs if you really wanted to save those, because each new round that we do, it's going to get rid of one of these from the practice rounds. So, oops, gosh darn it, hit the wrong one. Let's go back. Sorry about that. Got to go back to take a look at the courier for round 1C right there. Yeah, this was fun. Open it up. Actually, when I went to process this Monday morning, I was at home and I clicking it, sitting there, getting ready to take a shower or something. I can't remember. And my computer or the site wasn't working quite right. It wouldn't give me some of the stats that it usually gives me, so it didn't pop up in the usual fashion to satisfy my desire to see what the results were as soon as possible. But oh well, eventually I got to take a look. So anyhow, yeah, again, I jumped down. I like to look at sales first, and from Digby to Baldwin, really not a lot of difference, and Ferris even, in fact, 1, 2, 3 teams exceeded Ferris, and Baldwin was really close. Andrew's trailing a bit in terms of sales. Now, I got to look right up above that, because 1, 2, 3, 4, 5, each and every student-run team had a fairly good-sized emergency loan. I wonder why. We'll probably figure that out. Earnings before interest and taxes. Right, look at that. Erie had a loss. Even on pretty good sales, Erie had a loss. Profits. Baldwin led of the student teams. Ferris had the most here. Relatively small, contribution margins. Interesting, right? Erie, Erie had a loss, right? We say that. I come here and I look at that and I go 17.3 SG&A to sales. Now, they might have spent a lot that didn't drive sales. I don't know. Wasn't very efficient or effective, at least this round. But that's, if I had to guess right now, one of the reasons they had a loss would be that. Figure that's 8%, not quite, but close to 8% difference between that and the next highest. Take 8% of 120 and you're 9.6 million, right? So they spent an extra 9.6 million in SG&A. I don't know if it's extra, I may be using the wrong terminology there, but $9.6 million more than the next team, really, okay? And so that certainly contributed to its loss. Now, it may not have driven that kind of sales had it not spent that money. So again, that's why you can't say that that's the total fault of SG&A spending, but could be some. Okay, each and every student-run team sold shares. I'm still kind of shocked by that. I'm not going to beat around the bush too much anymore, but selling stock in this game, if you had something really, really important to invest in and you could not fund it otherwise, that would be something to consider. Otherwise, I got to tell you, I think it's one of the stupidest things you could do. Laying it on the line there, I guess we'll see who's listening to the videos or not. Erie, their stock just went up by 20%. Okay, amount of stock that they have outstanding went up by 20%. So they're going to have to earn 20% more to get the same earnings per share as they would have had otherwise. Now, if they could justify that by investing in automation, plant, TQM, whatever, maybe. And again, and not finance it some other way. Equity is expensive. Equity is really expensive. Okay, in the choice between debt and equity, which would you choose? Okay, which is cheaper? Okay, and Erie did borrow some money too. Okay, I don't know if they maxed out. They might have on the long term. They certainly did not, I'm sure, on the short term. Okay. So we see Andrews borrowed some money, Chester borrowed some money, and Erie did borrow a substantial amount of money, and still had an emergency loan and still sold a lot of stocks. So net income or loss, not bad losses. Even though Chester, Digby, and Erie all showed some losses, they weren't bad. Okay, for first round. It's always tough to get your arms around it. Look at that. We had decreases in cash due to increases in inventory for every team other than the computer team. So the computer team is a little more. And if I had to guess, because you guys outsold the computer team, it's not a guess then. You guys outsold, what did I say, 4 or 5 teams were either equal to or sold more. It means you guys made more. Okay, so Ferris did a little better job of predicting its sales. Yeah, computer might have a little advantage there. We'll see as the game goes on. I think that you guys will get that figured out. Okay, but because we had decreases in cash due to increases in inventory. Yeah. Okay, small things here and there. Depreciation. See a nice bump up there for Chester. We'll see that in a little bit here. Plant improvements. Andrews invested. Baldwin not much. Okay, Baldwin. In fact, not much is the same as saying nothing. Chester, big investment. Erie, bigger yet. Okay. Digby some. Digby and Andrews a little bit. Ferris went the other way. Ooh, why'd that happen? I don't know if we talked about that. That should have been a question. Maybe I'll add that. We'll see. Okay, we could add that as a bonus. Here's a bonus for people that are listening. How did Ferris get a positive number for plant improvements? Ferris and Baldwin paid a dividend. Okay, the sales of common stock and sold a decent amount of common stock. Okay, long-term debt. Erie issued quite a bit of long-term debt. Still ended up with emergency loan, smaller than some of the others, but still an emergency loan. So naturally, because they had emergency loans, all the student-run teams have zero cash. They do have accounts receivable, big inventory amounts. So there's quite a bit of inventory. You want to break that down by segment. You don't know what that is going into the next round, right? Plant and equipment, we should have seen big jump ups here and big jump ups here, right? Because they invested a lot. Big decrease there. Okay, I wonder why that is. Current debt, current debt's one that you can always, I think, raise about as much as you need, right, to offset potential emergency loan. In fact, one of your guys' questions is going to be about the cost for the emergency loan. Long-term debt, we saw some bump ups here and there. Erie quite a bit. Okay. Total liabilities. We'll see. It's going to be important to know. Okay, I saw up above that Chester and Erie spent a lot. Andrews and Digby a little less, but spent a lot of money in plant improvements, and so I'm going to be eager to see what that is. Okay, that should, as I'm scrolling down here, those things should be popping into my mind. What are they spending money on, and is that important? Okay, and if it's important, why? And if it's important, why, and how then can I compete against that? Do I need to? Or are they attacking a different segment? Maybe I'm competing against them, but I might not be competing with them, if that makes sense. Okay, so we got our sales, we got our variable costs. Again, I don't get too caught up in the variable costs, only as it relates to the contribution margin, because all things are relative. SG&A, yeah, Erie spent a ton of money. Be interested, in this case, it could have been R&D. Okay. Promo, sales, and administration. So we might, maybe Erie wasn't all in sales and promotion. Okay, maybe they spent some money. Yeah, we're gonna have to see. Okay, other fees, we won't see that really until we see TQM. Those are just small things that might relate to write-offs, different things. Might be fees, laying off people too, and things like that possibly. They're usually relatively small until you get to the TQM. Earnings before interest and taxes, we got our interest right now, not a huge amount of differences, although Ferris has quite a bit less, but student teams, some difference now. Okay, tons and tons of capacity, as we know. There's going to be tons and tons of capacity at the onset here. Still quite a bit. We are seeing, 4 of the 5 student teams are at least exceeding their first shift capacity. So come down here. I check out the inventory. Traditional, I'm just going to take a quick glance at all of them. Looks like a lot of inventory in the traditional segment, like that. So 2,100 units, 3,500, 42, 57, 5,800 units of inventory in the traditional segment. Now in the low end, 100, 25. Yeah, not many in the low end, right? High end, 148. 170, high end's about right? Couple hundred, awesome. Performance and size, 3, 3, 4, both of those have a few. Okay, both of those have some. Chester spent a lot of money. What'd they spend it on? Interesting, right? I don't see where they increased their plant capacity. Ooh, look at that. So they made a good effort here to update their automation. They did it by 1 point all the way down. It was kind of expensive, but they're going to see some efficiencies there and some productivity then in their labor cost. Okay, Erie spent a lot of money too. Remember, they spent even more. Look at that. Well, what'd they do? 2 new products. 2 new products are coming online. So they spent a ton of money. They also spent a little bit in automation, so it's no wonder Erie spent a ton of money. Interesting. So will an investment early pay off later? Maybe. We'll see. Okay. And then the curiosity is this. Remember their SG&A. SG&A also includes R&D, right? And R&D we don't see down here when we look at sales and promo budgets. Okay, and so I kind of said, yeah, maybe they weren't all that good with their sales and promo budgets, and they spend a lot. Okay, they did spend a lot. Look at that, 1,500, or $1,500,000, $1,500,000. So they spent quite a bit in their promo and sales budgets, but they should have also had to spend a decent amount in their R&D with the new products. Okay, and so there should have been a relatively high R&D spending too with the new products, but there's no question that they also spent a ton here, and they maybe weren't as effective as some other teams. In fact, EAT was, in terms of the traditional, quite a ways down there. Excuse me for a second. Okay, where was I? Yeah, we were talking about income, I think, and early on we're not going to see a ton of differences in the equities. I think I was down further than that, but I'm bouncing back up because I was down here looking at the productive things. We were talking about Erie. That's what it was, in their new products and what they spent. And they also spent, we see a lot in their advertising and promotions, and didn't do it that effectively. And generally when we have a disconnect there, it's because while they may be spending money on marketing and those types of things, they're not necessarily meeting the customer buying criteria, right? And marketing and stuff will help to offset that some, but it's not going to help to offset it a lot. And so if we're wondering why Andrews, that they have quite a bit, they had quite a bit of inventory left over in the traditional segment, and they're way down here, for say 4th, 5th, right? So let's take a look. Oh, not Andrews, I'm sorry, we were looking at EAT. Right? And EAT had a lot, okay, as much as Andrews, and it didn't sell even though it spent a lot of money over here. Well, why is that? Well, look at here. Okay, age. Oh, age is the first most important thing. So, they were probably lucky they had the sales that they had with an age, okay, that's that far removed from what the ideal age is, okay, and price, okay. Some of these things I'll be interested to see. Yeah, what happens sometimes in some of these is that they might have made a move, and sometimes you can get out too far. Let's see what they did up here. Traditional. No. Revision date. Yeah, I don't know. So they must not have moved that at all, it looks like, and so that's why it's 4 years old, okay? Sorry. Everybody, potential, everything was fine there. Here we had a little bit of, some potential versus, didn't Digby like that last game too? A lot of potential and not quite the actual, so they sold out, and even though they had the highest potential there in the low end, and why is that? Probably price being the main factor, right, in the low. So Digby had more potential, could have sold another, looks like 6% or so, 600,000 units, $18. So, that cost him about $10 million in sales there. Right, high end. Erie kind of jumping in there. Look at that. You remember last game in the practice rounds, Ferris dominated those ends. Okay, and it looks like maybe we've got a new player. Okay, and yeah, I kind of know what people said they were going to be doing. Talk about strategies. I can tell you first round, I already have a pretty good idea. If I didn't know, if you guys hadn't sent me, and by the way, I forget anyhow because I'm an old guy. But you can kind of look at what teams are doing, and at least the computer team stays the same, so we know what they're going to do. Out of the 5 teams, I'll bet you 2 or 3 you ought to have a pretty good idea of what their strategy is already. A couple of the other ones are kind of in-betweeners, and so it's maybe a little more difficult to tell. yeah. Kind of like to look down. Ooh. Here, Erie spent again a lot of money. Now they're getting better use down here in the high ends, right, of their dollars, right? And they got good, good customer awareness, pretty good customer accessibility. Their December customer survey has got a little bit maybe lower than Dixie. Just trying to see why we might have a little different. Could be the revision date, right? This revision date was later in the year, and so it might have a little more positive. Was this one late in the year as well? Yeah. Yeah, so fifth. So that's probably why that December customer. That means that those products are going to get a little jump out of the starting gate. Erie's not that far behind, and kind of see what the revision dates end up being next year as well. Pretty even in terms, again, actual and potential. Same thing here on performance. It's always kind of interesting. Just glance at these a little bit. Other teams competing. Digby competing well here in the performance. Okay. And in the size, again, yeah. Last game, everybody kind of gave it up to Ferris, and it looks like there's going to be a little more competition there now. So, actual and potential. We went over that for your question and answer last time, and we got a lot of evens. Relatively even, pretty darn even. There's little differences. Yeah, in the low end, about the only place where we saw some real discrepancies there, actual versus potential. And so if we came here, we could figure those things out. Not too big of a deal. Here, I like looking at the bigger perceptual map. When I try to look at these smaller ones, it hurts my eyes, actually. But when you look at the bigger one, you can start to get a sense, again, of what teams are doing. We know what Ferris is doing, right? And kind of take a look, and we can kind of see what the other teams are starting to do a little bit. I'm not sure what the hell Dell's doing or Digby's doing all the way back there. That's interesting. They were the lowest price, but kind of weird, but okay. We'll find out. Some of them I don't get, right away. We do have to wait a little bit for some of the teams. Nothing on HR yet, nothing on TQM yet, so that kind of gets us through it, right? Like I said, as we go along, I'll try to be a little bit quicker, but I might try to point out some things that might be on future assignments and whatnot. What about this week's assignment? Let's take a look. Ooh, lots of questions. Why did Digby have such a low contribution margin? So take a look. That one's pretty straightforward, I think. Okay, if you guys have listened to my prior videos, you will know that there's only two things really that go into contribution margins. So, it could be one or both of those things. Now, I would ask if it's possible to break it down a little bit, because that can be the case sometimes. Okay. Chester spent a lot of money on plant improvements. Where or upon what did it spend its money? So they did. Chester spent a lot. So did Erie. Erie's I talked about. There's pretty obvious. Chester, yeah. You guys need to figure that out a little bit. You might have to go back and look at the 0 round compared to the first round and kind of see. 3, approximately how much higher would Andrew's EPS be if it had not sold any shares? And the same for its ROE. Okay, and show your work. Show work. Okay, and same thing for here. Right. I'll put in the whole thing. Show your work. I should have had that in there. Show your work. Okay. And then lastly, and I'm going to count this one partly. Okay. Yeah, if you get it wrong, I'm going to count a little against you, but I might give you a little bonus if you get this one right and actually show your work again. What was the actual cost of your team's emergency loan? Okay. Get out your guide. Okay. Your guide's going to tell you what emergency loans cost. So get that out and take a look and figure it out. Okay. You should be able to. So there it is for your assignment for round 1C. For the teams that didn't win, I guess we need to see who won, huh? When we enter it into the spreadsheet, round 1C we were at down here, and so we'll make it a little bit bigger so we can see. Okay. we know that every team had a big enough emergency loan that they're going to get deductions for that. So earnings per share. Oh, Team Baldwin. Okay, followed by Team Andrews, because they were the only teams that were positive. Same thing with ROE then, they were positive, so that would be why they're leading there other than Team Ferris. Contribution margin was Team Andrews, followed by Baldwin, and stock price, Baldwin followed by Andrews. So they just kind of reversed order there. Ferris is getting a clean sweep down there. Profits, Baldwin followed by Andrews. Cash flow, Baldwin followed by Andrews. Strategy, and a clean sweep for Ferris, although Team Ferris had a deduction for working capital. Every team other than the computer team had a deduction for emergency loan, and a few teams for leverage. You get a little leveraged. 2.25 is my number there on the leverage. And working capital, 3 out of the 5 teams, 4 out of the 6 teams, if you count Team Ferris, all had deductions for working capital. So looks like Team Baldwin, congratulations. You guys won the first competitive round. I'm not going to bet on you for the second round. Sorry. I'll take my bet elsewhere. Okay? That should do it for the week. I hope everybody has a good week and good luck in round 2.